I mean, everybody thinks it's gold rising, but actually it's fiat currencies declining. And I'm trying to ram that message home because the people who will protect themselves from the multiple crises that are now in view, um, they're the people who actually understand that it's the paper currencies going down, not gold rising. And it's really for that reason that, when people ask me, what's your target for gold or silver, I don't give one. I mean, I've, you know, as a long-standing stockbroker, I know that every forecast you make is, is just something that you pluck out of thin air. No point in doing it. Silly game. So I don't do that. But also, the question should be phrased: how far do you see the dollar going down, or euro going down, or whatever your favorite currency is? And the answer to that, I'm afraid, is I think they're all on their way to zero. The question is, how long will it take to get there? That depends, I think, on how events unfold. I mean, we've got a potential war in the Ukraine and also in the Middle East, which could end up with being nuclear. I mean, obviously, it's goodbye everybody if we go down that route. But there is also the fact that the US dollar is in a debt trap. And there seems to be absolutely no recognition in the political class of the importance of that position. And they're still spending like Billio. The excuse is, and it's an election year, and we've got to get re-elected. And on top of that, I mean, we've drifted into socialism in Europe with France and now the UK. That's going to bring on financial disasters for both the euro and also sterling. And you can see that the Bank of Japan is suppressing interest rates at the zero bound. They're still zero. They're determined not to raise them. And at some stage, they're going to have to do it. But I think the biggest problem, which everybody is getting wrong, and I mean virtually everybody, is the outlook on interest rates. They think that interest rates are going to fall. They're not. I mean, they might come down a touch because central banks actually don't understand the role of interest rates. And also they're under huge pressure from markets to reduce interest rates. Also, they're under pressure to if you like, alleviate the problems in the banking system, which undoubtedly are exacerbated by current interest rates. I mean, look at the commercial real estate situation in America, for example. You've got zombie companies who cannot afford interest rates at this level, and they're gradually having to refinance themselves from the lower rates to which they became used. These are all disasters coming up, and I don't know which one's going to hit the fan first. I mean, nobody does, but it's all there. It is all there, and that will give you your timing. Well, if we look at Europe first, France going left is actually putting a huge strain on the political relationships within the EU. Italy has gone right with Meloni, and the Germans are sitting there, trying not to upset things. But there is no doubt that the Germans are getting impatient, if you like, about the problems that France is bringing into the euro. And I think, the whole of the euro system needs to be recapitalized. And we have a situation where France has gone communistic, if you like. I mean, I don't think it's an exaggeration to say that. You're right to point out the political pecking order is yet to be fully determined, but the indications are that this is going to be a very left-wing government rescinding a lot of the cost-saving things that Macron introduced. I mean, for example, like raising the pension age, that's going to be, rescinded, etc. spending, and I can see tensions arising. I mean, we've got used to riots in France. I think you ain't seen nothing yet. I think that's going to get a lot worse, because we've now got political tensions as well as farmers, upset about climate change legislation, whatever. I mean, France is going to deteriorate into a really rather nasty situation, and it's going to, I think, bring enormous strains on the euro. I suspect also that foreign institutions will be selling down French debt. There is the threat that the Saudis might do that. Also, the Japanese, who in the past have been heavy investors in French debt, they, I think, are liquidating their positions as well, or at least, liquidating long-term debt and switching into short-term debt, try and get away, if you like, from that risk. It's just not good. I mean, the starting point is a budget deficit of nearly 6%. I wouldn't be surprised to see that rocket under this new administration towards a figure like 7, 8, maybe even 9%. And once that's realized in the markets that is the direction which is going, I think the whole of the euro system is going to come under huge, huge strain. As far as the UK is concerned, we have a socialist prime minister masquerading as a moderate. And when you see, the cabinet, the new cabinet, the ministers, and you see them being questioned on this, actually, there seems to be very little difference from the previous administration. But there are big promises there. And I have no doubt that Starmer will come under pressure to satisfy the unions with increased legislation to help the unions. Legislation, if you like, with respect to minimum wages, with respect to I don't know about the 4-day week. That was on the agenda, but it's now probably off the agenda, sort of thing. Nationalising the railways, all these things. HS2, talking to the European Union about a closer relationship. I mean, this is a wish list, and it's not going to happen. But the one thing that we can be certain of is that we will get both rises in taxes, which will be aimed to penalise wealth. I mean, it's as simple as that. And at the same time, we'll get a rising budget deficit. And that is going to kill sterling. I mean, there is no doubt about that. Sterling is very heavily owned because London is a financial centre. It is the European financial centre. So that the global banking system has a lot of sterling balances. And so do the investing institutions. And I can see, I mean, what happened under Liz Truss is going to be a pimple of problems compared with the boil, I think, that markets will now lance. So the European situation is not a happy one, I'm afraid. Well, the first thing I would do is I would discount what William Browder says. I mean, he's grinding an axe. I mean, I sympathise with him, but basically he's grinding an axe, and it's not material to this situation. The backstory to this is really quite simple, and that is that the Saudis under Mohammed bin Salman basically kicked out the CIA. That was when he assumed power. Basically, he locked up the CIA's operatives within the royal family, kicked them out. He realised that the Saudi's future is with Asia, not with America. So that tie had to be broken. Now, if the future is with Asia, then obviously, being in the Asian camp, they would be very sensitive to Russia's position. And Russia has made it absolutely clear in the various St. Petersburg economic forums since the sanctions were applied on Russia and her foreign exchange balance is frozen, that their property had been stolen, and no government with any sense would actually hold their balances in dollars or euros and get their gold into their own possession if it is, let us say, stored in London or New York or Paris or or Switzerland even. So this was a message which was delivered to over 80 nations officially represented, 14,000 attendees from foreign countries back in the St. Petersburg Economic Forum in June 22. And the story has gone on from there. So really, I think that the message, the rumor, the story, whatever, that the Saudis have threatened to sell bonds is actually in accordance with what's happening anyway. I don't know whether they have actually said that. I haven't seen it. But there is no doubt that Mohammed bin Salman has moved away from America and the West because Saudi's main interests are now Asian. It's quite simple. It's India and China. And I mean, if you may recall, I think it was about 2 years ago when President Biden thought he ought to go and talk to the Saudis and persuade them to, if you like, increase their oil output. And I don't think he even got a meeting with Mohammed bin Salman. I mean, this was something which the Saudis just played down. I mean, they were polite, but basically piss off. And the next week, President Xi came in, and I mean, it was full ceremonial. It really was. Fighter jets flanking the presidential aircraft, and black chargers riding along by by President Xi's motorcade. The whole thing. Now that tells you exactly where Saudi's interests really lie. In fact, I had an inkling of this back in 2014 because I was speaking to a director of a Swiss refinery, and he was saying that they were taking in 400-ounce LBMA bars from Arab sources, which I assume includes Saudi Arabia, recasting them into the Chinese 1 kilo 4/9 standard, and returning them to their owners. So you think, why? Well, the answer basically is that they see their reserves, if you like, their store of money, real money as opposed to fiat credit, as being more marketable in Chinese standard than the LBMA standard. Now, that is a lesson for us. That was back in 2014. And here we are 10 years later, suddenly Bloomberg being surprised about what's going on. So, there's no surprise here at all, Jesse. It is accelerating. And I mean, the amazing thing is that we in the West are completely ignorant about what's going on. Russia is president of BRICS. There's something like 200 meetings were scheduled this year to, if you like, inform, educate, discuss, with BRICS members, the future and so on. And this includes the introduction of a trade settlement currency, which Russia wanted to introduce into the Johannesburg agenda, but failed to get approval, because if it's got to go on the agenda, it's got to get unanimous approval. India objective, China felt it was too early. But Russia's going to push for this, I believe. And I think I have seen a paper written by two, I think they were Chinese economists, about how such a currency would be constructed. They've called it the unit. Now, that paper was written late last year. I've read it, and it seems to me that the proposals are sort of really rather general. I mean, they're talking about this new currency being backed 40% by gold and so on. But so how it will actually pan out, we will see. I think that paper was merely a sort of form of introduction. It sort of get the debate going. And as a result of the debate, something will be put on the agenda in October, which is the next major BRICS summit. There are two things going on here. I mean, there's obviously BRICS, and the other thing is the Shanghai Cooperation Organization. Now, you're talking about Korea. That is not a member of the SCO, but there's no doubt about it that anything that happens in the SCO will also involve North Korea. On top of that, Putin also visited Vietnam. The point about SCO is that they have now agreed to work towards a defense agreement whereby all members of the Shanghai Cooperation Organization agree, if you like, to be military allies. I'm not going to put it more strongly than that, because this is something which is in formation. I think the point about it is that the intelligence services in the West will be alerted very clearly to what's going on. And this is desperately important when NATO is trying to expand itself into Ukraine. I mean, okay, it's sort of in semi-denial, but there's no doubt about it that, Ukraine's gone wrong for NATO. And there's a problem that the whole thing could well get escalated. So it makes sense for Putin to say, well, if things are going to escalate and you're going to lose patience over Ukraine, then bear in mind it's not just Russia you'll be fighting. There's the whole of Asia. And I think that was the message that he was trying to get over. And that was why he went to Korea, North Korea, and also Vietnam, and also the meeting with the SCO, which was only last week, where this agenda was agreed. Well, anyone who says that silver is demonetized, basically is rubbing up against common law. Common law based on Roman law, money, if you like, without counterparty risk, was gold, silver, and copper. I mean, it's as simple as that. Now, obviously, we think in terms of gold. Silver is not priced as a monetary metal, because if it was, then we would be looking at the sort of relationship to gold that pertained in the 1870s, or up until the 1870s, when there was about sort of 15 to 1 ratio, something like that. Obviously, we're now looking at 76 to 1 ratio. It is not being priced as a monetary metal. It's as simple as that. There is no doubt, however, I mean, you just look at the Silver Institute's estimates of supply and demand. I mean, there's been a deficit in terms of the sum of mine and scrap supply compared with demand. And that's a deficit which has been around now for nearly 4 years, and is only satisfied by drawing down on silver stocks, above ground stocks, which predominantly are either held in investment hands or alternatively are held as strategic stocks. Now, strategic stocks were extremely common back in the old days. I mean, we're going back to the days when Bretton Woods was around. But it's not so common now, with one notable exception, and that's China. China has accumulated quite a lot of silver. I haven't been tracking that too much, but I do know that they have, in effect, been controlling the price with a view to accumulating stocks of silver. And the way in which industrial demand for silver has gone, explains that it was a perfectly rational thing for the Chinese to do. I saw someone the other day suggesting that a large seller might dump silver on the market to screw the price. I think that's extremely unlikely. It's too precious a commodity, an industrial commodity, for anyone to consider doing that, because they know they would just lose control over their silver. Why do it? So that's not going to happen. The fascinating thing is that virtually everybody dealing in gold doesn't actually understand the monetary status of gold. They've got this sort of vague idea, if you like, that there's a history and da-da-da-da-dum. But actually, they don't understand the legal position that gold is money and the rest is credit. This is the way it was described by J.P. Morgan back in 2012 to a committee of Congress. It's still true today. And this is actually based on Roman law, which goes all the way back to the 12 tables in 450 BC, formalized by jurors over the next 1,000 years, and then crystallized in Justinian's pandemics, and also the basilica for the Eastern European Empire, and that was about 900 and something AD. So, and all the successor nations from the Roman Empire, which actually happened to colonize the world, have this in their common law, that gold, silver, and copper are actually money, or can operate as money. They are the money of last resort. Everything else is credit, whatever. So few people understand this. I mean, when I talk to gold bugs, supporters of gold, I mean, yeah, they're gung-ho for gold going up and all the rest of it, but they don't actually understand the status. And a lot of these people think that Bitcoin, is the future for money. But Bitcoin has no legal status as money. That's not going to happen overnight. I mean, I don't know how, I'm not going to get drawn into that debate. But the important point is that when you look at silver, when the price of gold goes up, which, as I say, is actually the value of paper currency going down, there's that faint echo in silver, if you like, that the more that this paper currency is going down, some moneyness is returning. The ghost of money is going back into silver. And, the relationship is a catch-up one. So what we typically see is gold goes up 1%, silver goes up just under 2%. But when the fears, if you like, surrounding paper currencies diminish and the price of gold drifts, then under those circumstances, silver drifts even faster. And that's why it has been actually such a disaster for so many for so long. But of course, now, with all these disasters, which I enumerated at the beginning of this interview, you can see that anyone with any sense can see that, the end of the fiat era is hoving into view. And under those circumstances, you've got to think about silver as a monetary asset, as real money, if you like, in the original legal sense. So I hope that answers your question. What I would do is, the old sort of saw about, history rhymes rather than repeats itself, if you like. So I wouldn't put too much emphasis on, the historic, what happened in history, but I would try and argue it, if you like, from a contemporary position. What we are basically seeing is the value of credit going down. And if you look at dollar credit, now credit in dollars is both the currency, because there is a balance sheet entry on the Fed's balance sheet, liability, which is the dollar notes which you may have in your possession. Bank reserves are actually a liability at the Fed with exactly the same status as banknotes. So you can see that currency is credit. It is, if you like, a higher ranking form of credit than, let's say, a bank deposit, because a bank deposit introduces credit risk that the bank may not pay you back as a depositor. Everything you do, bonds are credit. The way to discern whether something is credit or not is to think, is there a liability or an obligation on one side, or a debt on one side, and a credit on the other? And if the answer is that something is backed by an obligation, like a bank deposit, you don't actually own, the credit, if you like, in the bank, in your deposit account. It is owed to you by the bank. When you deal in derivatives, these are all credit. Even when you deal in equities, those are credit. Because what is an equity? An equity is an obligation of the management of a company to pay you a future income stream, or at least accumulate it on your behalf on the company's balance sheet. Now, that is not a material asset. That is credit. Okay, I know you sort of think in terms of, well, ownership of shares is actually ownership of a part of a company and all the rest of it. No, it represents the ownership. It is an obligation. And worse than that, the whole financial system now works off certificates of entitlement. And what does this mean? It means that certificates have been dematerialized. You no longer have evidence of your ownership, if you like, of equity in a company. In a company, it's that is now bound up, if you like, in the central counterparty, which actually owns the certificate. Again, the credit, it owns the credit from the company, in return for which it has an obligation to you to deliver that, or to deliver it to whoever you say. Well, if you sell it in the markets or whatever. But you don't own it. You have got credit twice over. You've got two links of credit between you and your supposed ownership of a portion of the company. So everything other than physical gold, physical silver, but particularly physical gold, because we'll talk about that to keep it simple. Everything but is credit. Absolutely everything. Even if I have, I have a gardener who comes once a week. He does his work and then I pay him. Now, in doing the work, he is actually relying on me to discharge my credit obligation to him in payment for his work. Everything is credit. Right. Now what happens when that collapses? Everything goes. Absolutely everything goes. Without fear or favour. You're going to lose. And also when it comes to property, incidentally, how do you value property? You value it in credit. So valuing property in credit, you don't escape the idea that you actually own bricks and mortar and all the rest of it. You don't escape this credit problem. You are bound up in it. There is no escape. The only escape is to own physical gold or physical silver, but particularly physical gold. And if you expect a collapse, let us say, in the dollar or whatever your domestic currency is, then everything in the economy is going to go tits up. So I'm afraid that is the reality of a collapse in credit. And people just don't understand this. And if we talk about the dollar, let's just be specific, because the dollar is now in a debt trap. What do I mean by debt trap? It means that debt is soaring out of control. Think in terms of interest payments. They don't pay interest. No, they just roll it up all the time. So, this is going off like that. Now, the dollar is very heavily owned by foreigners. If you look at dollar credit owned by foreigners, according to the US Treasury's TIC figures, Treasury International Capital System statistics, got around about $32 trillion of credit in foreign hands. 32 trillion, which is more than US GDP. They are now reducing their involvement. Where they're reducing it particularly is at the government level. The government is finding it very hard to finance itself by getting foreigners to stop selling their credit and actually buy more. Stop selling their debt, if you like, and actually buy more. China stopped buying. The Japanese institutions have stopped buying. Well, it's not entirely true, actually. The Japanese institutions have stopped buying term debt. But where they hold on to their dollars, they will just accumulate T-bills, anything under 1 year, which pays you 5.25%, 5.4%, whatever. And what you don't want, if you're a foreigner, is you don't want that duration risk. So there is a real problem here. So the question you need to ask yourself is, at what level at what interest level, what coupon level can the US government fund itself? And the answer, I'm sorry to say, is somewhere quite higher than the current level. I mean, if you look at the 10-year, it's around about, 4.2%, something like that. I mean, we had this situation in the UK back in 1976. And I distinctly remember 3 tranches of medium and long-term gilts being issued with coupons of 15, 15 and a quarter, 15.5%. Now, just imagine what that does to US government finances. I mean, that's basically where it's going. I'm not going to make a forecast as to where it will go, but you can see that the Fed is now stuck because it is not controlling interest rates at all. Okay, it's talking a good talk, but it's got no control over interest rates. This is being set by the markets. If they lower interest rates, all that happens is the dollar gets sold. And we've seen this actually today. I mean, just a smidgen of it. I mean, there's sort of some talk that, the inflation figures are sort of better than expected, and therefore it's more likely that there will be a cut in the Fed funds rate in September. The chances have improved, and all this rubbish. And what happens? The dollar's trade weighted falls by 0.6%, something like that, and gold soars up to, as you rightly pointed out at the beginning of this interview, to around about $420, a rise of nearly $50. What that move is telling you is the dollar's going down. And if the Fed sits on interest rates, it's just going to kill the dollar. This is exactly what the Bank of Japan is doing. That is why in the last, sort of 7 or 8 months, the yen has gone from something just over par to 160. In other words, it has declined down to over 160 because the Bank of Japan has been absolutely adamant that it's sitting on interest rates and will not allow them to rise. This is it, and again, they've been sort of talking about, well, we're going to taper, but it doesn't happen. I mean, I tell you, the central banks have got themselves into a real hole here. And I can't see that they've actually got a way out of this. The way out of it is actually not in their control. The government has to balance its budget, produce a surplus on its budget, and continue to do so in the future. Then I would change my mind about the prospect for dollar credit, Japanese credit, euro credit, whatever. Well, if you get a collapse of credit, I'm afraid that that's worthless. You don't own anything. There's some sort of meme about the World Economic Forum saying you will own nothing and be happy. I mean, I'm sorry, we're already there. This is not good news. Now, having said that, I think there may be a play with mine stocks or producers of commodities, because the safe haven is not just gold, but it is also commodities. And thank goodness, I mean, I don't like the guys, but thank goodness we got Russia and China who are isolating themselves from our troubles, which means that the majority of the world is actually going to survive this, even though we're going back to the Middle Ages. I mean, this is something that's never been experienced in America, because the Middle Ages ended before America was even discovered. But, I mean, that is how serious this situation is likely to pan out. The value of your equities, is in credit. I mean, quite honestly, you could have, let us say, Nvidia's shares being $1 million, but $1 million won't even buy you a cup of tea, So, do you really want to invest in it? No. The problem is credit. Get the hell out of credit. That's really the message. I think with mines and commodity producers, there may be a way out, as it were, in terms of there will continue to be demand for what they produce. That demand can be measured in gold. I have no doubt that China and Russia and its close allies will move on to a gold standard, whether it's a common gold standard or new BRICS currency, whatever. They are moving in that direction. They have the gold in order to be able to do it. We have to take it on trust that they will do it properly, which, frankly, I doubt. But anyway, I really do think that there is a future for mining stocks, but they have got to get over the problem of fiat currency costs. they will find that the dollar price of energy will go through the roof. The dollar price of equipment, the dollar price of employing miners and all the rest of it will go through the roof. So the whole economics of mining is going to shift very, very substantially. And anyone who's looking at hedging out of credit into something which is still credit but could probably be tied to gold in the future or tied to a commodity which will retain its value has to look at the changing circumstances in which a mining company will operate. There's not a simple answer to this one, Jesse, I'm afraid. I think it's quite a complex thing, and you have to know what you're doing. You've got to think pretty hard about it. But in the absence of that, I mean, the message is quite clear. Just get the hell out of credit. None. Have none. Get out. It's as simple as that. And I mean, we'll talk about supply and demand for gold, and I'm sure in a moment. I'm sure that'll be one of your questions. But what we're seeing is something which is happening as the subjective value of these fiat currencies declines. Why does a fiat currency have any value? Well, I mean, it was summed up in. It was a different context. It was some sort of Congress meeting, evidence, whatever. And there it was said that the dollar's value basically depends on the faith and credit of the US government. Damn right it does. That's all it is. You take away gold. If you don't swap it for gold on demand, then that's all it is. The faith in the credit of the US government. Do you have faith in and are you prepared to credit the US government? I'm not.
Very interesting breakdown there. Let's talk about the gold supply-demand scenario currently. I'm wondering what your thoughts are on central bank buying. Obviously, this has been a big story over the last few years. We recently saw Uzbekistan actually add to its gold reserves. That story continues to play out, central bank accumulation. How impactful is that going to continue to be? What are the other main demand drivers versus the current supply?
Okay, let's talk central banks first. The People's Bank of China has been buying gold, but actually it hasn't been buying gold, it's been selling dollars. It's been reducing its dollar commitment. Now, as to whether it's frightened about the future value of the dollar, or whether it is merely in line with the Communist Party's meme of reducing the involvement of the dollar, you can pick either of those reasons. When we look at the other central banks, predominantly in Asia, who have been accumulating gold, again, I think there are these twin reasons. They can see that the geopolitics is actually working against the dollar. So the dollar's value is likely to decline on that basis alone over time. Furthermore, they can see, they will know, they have the inside track. They have these sort of quiet meetings to which we are not privy. Amongst the monetary panjandrums, if you like, in the Asian central banks, knowing that they're moving towards a gold standard. It's probably some way off, but obviously you need to accumulate some gold. Now, India is very interesting in this because India has denied gold. India has been Keynesian in its approach to economic management. And I think that also includes, sort of a sort of semi-official view that gold is a pet rock. But that has now changed. The government is now accumulating gold. Why? Because they're a member of the Shanghai Cooperation Organization. They're privy to the conversations, and they know that that's the direction in which it's going. They don't want to be first going there, but they know that they would be complete idiots not to accumulate some gold, even if they hope the problem will go away. So that, I think, is what's happening at the central bank level. Now, at the market level, we have seen for well over a decade now that the Chinese in particular have been stripping gold out of Western vaults, out of Western mines, whatever. They have been accumulating gold. I have a copy of, in English, of the original articles appointing the People's Bank of China to act for the Chinese nation in the accumulation of gold and silver, and that was dated in 1983. Now, since then, there's been massive investment inflows, and in through the 80s, and in the 90s, massive and growing. Through into the 2000s as well and beyond, growing export surpluses. Now, all the foreign exchange transactions are handled by the same organization, the People's Bank of China. So all those flows go across their desk. Now, if you're old enough to remember how central banks, how conservative individuals, non-speculating individuals, those who wanted to protect their wealth for the long term, how they looked at gold, and this would include the Chinese. They reckoned that you should have somewhere between 10 and 15% of your money in gold, and the rest is credit for you to, do whatever, buy houses, buy expensive yachts or whatever. That's the Arab approach. And I think that if you just take that 10% and you look at the cross-border flows, firstly, the big capital inflows in the 80s, and then the growing surpluses with continuing inflows, the amount of stuff crossing the PBOC's desk, you take 10% of that at contemporary prices. And remember, this was a bear market that took the gold price down to $250 in 2002. Then I reckon that was over 20,000 tons. That's a substantial amount of gold, the largest, in fact, of anywhere in the world. Interestingly, I mean, this is speculation on my part, but in support of this speculation, bear in mind that the Chinese rapidly invested in their gold mining industry to the point where gold mining became the number one gold mining nation by output, really quite rapidly, and have been ever since. Remember also that gold going into China never gets out. I mean, I referred to this the Swiss refiner, director of the Swiss refinery, who I had a conversation with, and one of the other questions I asked him is, "Have you ever seen any Chinese refined bars?" And he said, "No, we never see them." In other words, I mean, I asked him the same question about 7 years later, and he said, "Well, it's been reported a few, but we think they were smuggled out of China." So in other words, China is Hotel California for gold. It goes there and you never see it again, okay? Also, coincidentally, in 2002, the Shanghai Gold Exchange came into operation, which permitted Chinese citizens to accumulate gold as well. And indeed, the state advertised on television, "Buy gold, it's good for you," or whatever the byline was. So you can see that the Chinese approach to gold is that this is money. This is the ultimate form of money. It is the ultimate protection we have against the West. And at some point, we may have to deploy it. This is a very, very important point to understand. Now, contemporary. Let's look at the contemporary situation. Incidentally, the Chinese population, which is 1.2 billion people, have accumulated roughly 27,000 tons of gold if you just go on what's been withdrawn from the Shanghai Gold Exchange. There's also a certain amount of gold flows from Hong Kong. When tourists from China go in, they buy gold in Hong Kong, which is sales tax free, and they can just walk in, and nobody actually stops them going into China. So, you can see government policy is extremely gold friendly. Now, let's get up to date. If you look at the savings ratio, the savings ratio in China is over 40%. But more importantly, the household savings. In other words, this is just households. These are individuals who are saving, if you like, their own earnings, their own profits, whatever. is estimated to be 35% of China's GDP. That is roughly $6 trillion. So you've got $6 trillion of savings going into property, stocks. It can't go into foreign currencies because there are exchange controls. That's not permitted, and it goes into bank accounts. Property is no longer fashionable. We needn't discuss that. The stock market for the last 3 years has gone down very substantially. It's recovered a little bit this year, but I would suggest that the sort of rather conservative saver in China is not really all that switched on by the stock market. So what do? Well, it's all been accumulating in the banks. And the banks offer what they call certificates of deposit, which is slightly different from our CDs. A certificate of deposit in China is basically a deposit of up to 3 years with a fixed rate and a better rate of interest than, let's say, instant withdrawal or 1 month money or whatever. But these banks also offer gold accounts. And this is something which was brought in by law, getting the banks to do this. And that's all part of the gold ownership story, which China is working towards as a means of its ultimate protection from our attacks on China or our attacks on ourselves as we destroy our own currencies. All you need to have is 500 yuan, maybe 600 yuan in some banks. That's the equivalent of about $70 to $80 in order to open a gold account. Now, I don't know whether the banks, match the gold account with physical gold completely. I don't know. I suspect that they probably run a sort of fractional reserve system. I doubt if it's highly leveraged. I very much doubt that because they know the official policy. And I would think they're in the market picking up gold whenever they can. When it's offered, take it. I think that's what they've been doing. And just bear in mind that the alternatives for this $6 trillion equivalent. $6 trillion, incidentally, at the current price is 75,000 tons of gold. I mean, we're talking a considerable amount of moolah here. Excuse me. So, you can see how it is that the shortage of gold in Western markets has been getting greater and greater and greater. You only got to look at COMEX and see the withdrawals. Now, the withdrawals don't necessarily go out of the vaults, but they certainly go out of the possession of the liquid hands, if you like, in the COMEX market. And I mean, there's staggering amounts being withdrawn. And now it's also happening with silver. So where does gold go in this? Well, let's put the monetary thing aside and just think in terms of supply and demand. Well, there's no supply and there's demand, which on rising prices could indeed become self-feeding, because another aspect which various of my friends have noted is that in the futures market, the Chinese speculate wildly. I mean, they want leverage. They really do. We're talking about Chinese traders, not the housewife. They know that, they're close to the financial system. They know the story I've just been telling you about the People's Bank, etc., about the official attitude to gold, the official attitude to the dollar, and so on and so forth. So, bang, they're in there. They're buying futures and cleaning out. And that, of course, is putting strain on our futures and forwards markets in the West. So if you ask me what's the future price for gold is, just looking at it from not a monetary point of view, but from supply and demand, how high? So, to my mind, this is an extraordinary setup, and I think it's, I rationalize it more, if you like, from the understanding of the difference between money and credit, which is actually the fundamental driver under this. This is something the Chinese understand more than us. I understand in Mandarin, I don't speak Mandarin, that the word for money is the same as the word for gold. And that tells you, I think, all you need to know about, when they see trouble in the West, that's where they're going to go. And we should follow them. We should follow them very, very closely. Don't hang around listening to the propaganda coming from our politicians and our monetary committees. I mean, they haven't a clue. They really haven't.
Well, that was once again a very detail-oriented breakdown there, which I very much appreciate. And that is also what you do in even greater depth on your Substack. Could you tell us about that, where people can find it, and what it is you do there?
Yeah, sure. The Substack is alasdairmacleod.substack.com. You probably won't be able to spell my name, it being very Scottish. But another way to get there is Google Macleod Finance, and you'll find you'll get led to it. And really, I'm still head of research for Gold Money, but I wanted to broaden, my appeal, as it were, in terms of educating people. I wanted to have a platform where I could actually incorporate not just explaining economics, money, credit, interest rates, gold, silver, geopolitics, also politics to a degree, which Gold Money, I think, quite understandably, is very sensitive, that I shouldn't really get too much involved with. So I can do that on my Substack, because it's all part of educating a wider audience about the dangers which we face in these very, very difficult times. And I really do want to get that message out as widely as possible. And really, I mean, a subscription for my Substack is a couple of Starbucks coffees a month, which I don't think is too much of a burden. Hopefully it will give you a lot of protection for the future.
Great. Well, I'll put a link in the description below to the Substack so people can check that out. Thank you once again, Alasdair, for coming on the show and sharing your knowledge with the audience.
Thank you for having me, Jesse.
And thank you for joining us today. As a reminder, this episode is brought to you by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.